Rod, it's great to have you back, and I'm sure our viewers remember you've been net cautious on the name relative to a lot of your peers. How did that play out in terms of the supply issue versus the demand issue, which others would argue maybe is a lot stronger than your view?
Hey, Carl. Well, the answer is both. If you look at the supply issue, it was worse than we thought. We thought that the supply chain impacts in this quarter, based on Apple's commentary, would be about $4 billion. They turned out to be $6 billion, so that's quite a bit worse. A lot of that increment was iPhone due to some Southeast Asian production issues. So, you know, there's a lot of supply in here. But on the other hand, if you adjust out the supply chain impacts that Apple called out last quarter and this quarter, you end up with sequential growth of 7% on revenue. So quarter-on-quarter growth of 7%. We would expect 20%, like you go back in 2018, 2019, in a September when you're launching the iPhone in that, you know, that quarter, you would expect about 20% growth. So that adjusted growth is lower than we would have anticipated. So that's not a great demand signal either. But like I tell everybody, this is a tough end of the year period to forecast, and that's an understatement. I think it's very early to make a call on where demand is going here, given all these supply issues.
Yeah, and you write this morning, consumers could easily be walking away from purchases owing to longer lead times. That's a big debate on the street right now because demand destruction is a economic dynamic for sure. Others argue that as far as Apple goes, there's no demand heaven. People will buy, just maybe later on.
Right. Yeah, you could easily have people delaying purchase decisions. They go online, they find the delays a month. They say, forget it. You know, I'll wait another month or 6 weeks. So you just, at this stage in the game, you just don't know. It's really, really early. Apple's demand comes very heavily weighted at the tail end of the quarter. And, you know, so does all the retail demand. So none of us really know how that's going to come out. And all these supply things just, you know, create a lot of noise around all that.
Yeah, Rod, I mean, just for the services, which obviously has been a big talking point for this company for a number of years now as it's transitioned and tried to grow more of that base as well, that higher margin business. 745 million paying subscribers. That was compared to 660 million 6 months ago. All the supply chain talk, the revenue miss, or is that overshadowing what we're seeing happen for the people that do have their devices and are using them right now?
Yeah, that's certain. Let me comment on services. A lot of that services rebound you're seeing has to do, we believe, with Google TAC. Google's seen some very rapid pickup in advertising as we've exited COVID. That's really helped Apple as well. That's about a third of your services profits. And then App Store is also doing really well here. You still have a lot of people working from home, downloading apps, playing games, et cetera. We do think that App Store activity will moderate as we exit COVID here, and you know, people go out to restaurants and things like that. So I think whatever we're seeing in services today is probably a little bit of a head fake in the positive direction. We'll probably see that slow down as we head into the beginning of the year and, you know, reopening continues.
You know, Rod, from the stock perspective, I mean, you've been right to have it neutral. It's only up 11% versus the higher gains in the broader market. What would you need to see from the company, from your perspective, to consider, you know, saying, all right, this thing's a buy?
Yeah, well, there's a couple of things. One thing on the fundamentals, we continue to look at the ARPU. We look at average revenue per user of those billion users, and we think about the trajectory of that ARPU, which was really flat as we headed into COVID, and then it's grown by about 20% in COVID. So we expect that ARPU will roll over the other direction as we head into next year. If we were to see more stability in that, or you know, maybe even growth in that ARPU, that would make me change my mind from a fundamentals point of view. Right now, I have this view that subscribers aren't growing and ARPU is not really growing. That's not good for growth. And yet the stock trades on 28 times earnings, or our earnings number anyway, which is a little bit below street. So, you know, that's well above the S&P 500. I just don't think it deserves that multiple if it can't grow any faster than what we think is going to play out in the next 12 or 18 months.
Why do you have that view, though, on ARPU and subscriber growth?
Well, ARPU, Apple themselves released iPhone installed base numbers 2 years apart that show you a 5% CAGR on that iPhone installed base. That's the best estimate you've got of the subscribers that Apple's got. That number is probably slowing. It's an S-shaped adoption curve globally. So likely we're headed toward GDP growth on those subscribers. And then ARPU was running at about call it $275, $273 in our numbers in 2019. It bounced by 22%, or just over 20%, to about $320 we estimate this year. So that's a big jump in ARPU that was very stable at that $275, $270 level for 3 years before COVID. So ask yourself, maybe these devices have gotten more valuable to people. Maybe that ARPU will hang higher than that 270 level, but my guess it's not going to stay up at these inflated $320 levels.